Open your brokerage account right now and actually look at your portfolio. If you're anything like most investors over 40, I already know what you're going to see. You bought VOO because Warren Buffett said so. You bought QQQ because your neighbor made money on tech. You added a dividend fund because someone said you need income. Maybe you threw in something you read about online. And now you have a messy, overlapping pile of funds with no clear strategy connecting any of it. Here's what bothers me about this. Most people are asking the wrong question. They're asking, what's the best ETF to buy right now? And I get it, that's a reasonable thing to wonder, but that question is almost useless without context. The right question is, what specific job does each ETF play inside your retirement machine? Because an ETF is just a tool, and you don't build a house with 5 hammers. You need the right tool for each job. Today, we are not doing a random list of top funds. We are building a 5-part retirement machine, 5 distinct buckets, each with a specific job. And then I'm going to show you the exact math on how to blend them based on your specific age, whether you're in your 40s, your 50s, or stepping into retirement right now. Let's get into it. Bucket 1, Core Growth Engine, VOO. Every machine needs an engine. For your portfolio, that's your core growth bucket. One mission, broad, relentless capital appreciation that outpaces inflation over the next 10, 20, or 30 years. The fund I'd study first for this slot is the Vanguard S&P 500 ETF, ticker VOO. Look, I know this isn't a secret, but there's a reason it crossed $1 trillion in assets in 2025, the world's largest ETF by a wide margin. VOO gives you the 500 largest, most profitable companies in the United States. You can buy one share and immediately own a piece of Apple, Microsoft, Nvidia, Amazon, Meta, and hundreds of others. Now you might be thinking, why VOO and not SPY? They track the same index. The answer is cost. SPY charges you 0.0945% per year. VOO charges 0.03%. On a $10,000 investment, that's nearly $10 a year versus $3. The gap looks small until you compound it over 25 years. And if you want to take it one step further, there's SPYM, formerly known as SPLG, which charges just 0.02% per year on the same S&P 500 index, 1 basis point cheaper than VOO, and currently the lowest cost S&P 500 ETF available. For investors making regular contributions, the lower share price also makes it more practical. One critical note for 2026, the S&P 500 is extremely concentrated right now. The top handful of tech companies make up an outsized percentage of the entire index. That concentration risk is real, which is exactly why we're building 5 buckets, not just one. Bucket 2, Dividend Growth, SCHD. You don't just want a fund that pays you a dividend today. You want one that grows its payout every year, so your cash flow actually beats inflation over time. That's the Schwab US Dividend Equity ETF, ticker SCHD. This fund has a cult following for a reason. Expense ratio, just 0.06%. Current yield, approximately 3.2 to 3.5% paid quarterly. And here's the part that matters most. SCHD has delivered consistent dividend growth for 14 consecutive years. But most people don't actually understand how it works under the hood. SCHD isn't just a dividend fund, it's a quality filter disguised as a dividend fund. To even get through the door, a company must have paid a dividend for 10 consecutive years. Then Schwab runs every surviving company through 4 financial screens: cash flow to total debt, return on equity, current yield, and 5-year dividend growth rate. Only the top 100 companies that survive all 4 make it in. What does that buy you? Mature, cash-generating businesses, concentrated in healthcare, financials, and consumer staples. It actively strips out volatile, overpriced tech speculation. When the broader market corrects hard, SCHD has historically held up better, while still paying you a rising stream of cash. That's a different kind of safety net. And for investors who are 10 to 20 years from retirement, the compounding effect of that growing dividend is significant.
Bucket 3, pure income, JEPI.
Now here's the question. What if you don't have 15 years to wait for dividends to grow? What if you're 58, retirement is 3 years away, and you need high, reliable income right now to actually cover your mortgage and your bills? That's bucket 3, pure income. The fund I'd study here is the JP Morgan Equity Premium Income ETF, ticker JEPI. Expense ratio, 0.35%, reasonable for what's an actively managed strategy. Current yield, approximately 8% to 8.5%, paid monthly. As of mid-2026, the trailing 12-month yield is running closer to 8.2%. How does it generate that much cash without blowing up? JEPI uses a covered call strategy. Plain English version, the JP Morgan team builds a lower volatility portfolio of S&P 500 stocks, then essentially sells insurance contracts to other investors, the right to buy those stocks if they spike above a certain level. In exchange for capping their own upside, they collect cash premiums, and those premiums get passed to you every month. Here's what most people don't realize. JEPI is not designed to beat the market. That's not its job. If the S&P 500 rips 25% in a year, JEPI will underperform, structurally. But if markets grind sideways or drop, JEPI keeps paying you roughly 8% while you wait. For someone nearing retirement who needs sleep and income, not maximum upside, this is a serious tool. One important trade-off, JEPI's distributions are mostly taxed as ordinary income, not qualified dividends. This makes it significantly more efficient inside a Roth IRA or traditional IRA than in a taxable brokerage account.
Bucket 4, Tech Booster, QQQM. We've built the foundation, the quality income stream, and the cash flow machine. But if you want to capture where the modern economy is actually going, AI, cloud infrastructure, commercial space, you need a concentrated tech position. This is where the most interesting update of 2026 lives. The fund I'd use here is the Invesco NASDAQ 100 ETF, ticker QQQM. Note the M at the end. Here's the wealth hack most people miss. QQQM and the famous QQQ track the exact same NASDAQ 100 index. Same stocks, same weights, same returns before fees. But QQQ charges 0.18% per year. QQQM charges 0.15%. Invesco built QQQM specifically for buy and hold retail investors. That 3 basis point difference is money that stays compounding in your account, not theirs. Now, here's the actually surprising part for 2026. SpaceX, which completed the largest IPO in stock market history on June 12, 2026, raising $75 billion at a $1.75 trillion valuation, entered the NASDAQ 100 on July 7, 2026, which means if you hold QQQM, you now own a position in SpaceX automatically. No IPO allocation fight, no timing the market. It came to you. This is worth contrasting with VOO and other S&P 500 funds. S&P Dow Jones indices maintained their existing profitability and seasoning rules. SpaceX posted a $4.28 billion GAAP loss in Q1 2026 and won't be eligible for the S&P 500 until at least mid-2027. VOO holders do not yet own SpaceX. That subtle difference between indices changes everything for how you think about each bucket. Use QQQM as a satellite position, not your core. You bolt it onto your foundation for aggressive growth exposure. One potential drawback is that the NASDAQ 100 is heavily concentrated in tech and can experience sharp drawdowns. That's why this bucket shrinks as you approach retirement. Bucket 5. Defensive quality layer, moat. This is my favorite bucket and the one the mainstream financial press almost completely ignores. If you want to protect long-term wealth, you need to own companies with structural advantages that competitors genuinely cannot replicate. Network effects, switching costs, proprietary technology, cost structures no one can match. Warren Buffett called this a wide economic moat. The fund for this is the VanEck Morningstar Wide Moat ETF, ticker MOAT. Expense ratio 0.46%, higher than our core funds, but they're doing significant analytical work for that fee. Morningstar's analyst team evaluates U.S. companies for the width and durability of their competitive advantages. But Moat adds a crucial second filter. It only buys these companies when they're trading below their estimated fair value. Not just great companies at reasonable prices. The fund currently holds approximately 50 to 60 U.S. companies, and here's a structural edge that most people overlook. Moat is equally weighted. Every position has roughly the same influence on returns. The smallest company carries the same weight as the largest. This is the opposite of the S&P 500, where the biggest companies increasingly dominate.
So there's the full system. VOO, Core Growth Engine. SCHD, Dividend Growth and Quality Income. JEPI, Monthly Income, Near Retirement. QQQM, Tech and Growth, now including SpaceX. MOAT, Defensive Quality Layer.